Today, covering non-farm payrolls, rate cut odds, and what traders might be missing. Interesting story from this morning. If we kick it off with the first slide, non-farm payroll report delayed, supposed to come in last week, but arrived today and set us up for an action-packed week here in SpotFX markets because we had this January payroll report coming in today, and we've got CPI, consumer inflation, coming out on Friday. And so we had a big surprise to the upside, 130,000 jobs added. Expectations for this one, I didn't put in, a round number consensus expectation because of the delay, people changed their expectations, but most of those revised expectations were to the downside around, 70,000 all the way down to 55,000 added expected. So regardless of what or who was expecting a 5-digit additions for January jobs, we got 6, and unemployment coming down yet again to 4.3%. That was supposed to come in flat at 4.4. A bit of an interesting story in the revisions, that slowdown in hiring, but that'll always be the case where we have revisions, have people not trusting these. But regardless, a bit of a volatility shock for the morning here in the U.S., leading to some widespread dollar strength. But over to the next slide, because this is where it plays out and why any of this is relevant. We got a pushback in rate cut odds yet again. Now futures pricing from the CME looking like June as the first FOMC meeting where the odds tip over 50% in favoring a rate cut of any magnitude, centered around 25 basis points, of course, but some tail risk for more than 50. And here we're just looking at the next meeting, March 18th, what those rate cut odds are. I mean, fully pretty priced in already, around 80-20, that there would be no cut in March. But here's an instance where we kind of got over another hump and we saw a move in these expectations of around 15%, and that takes us into, the territory where we will see from now, it would be very surprising for us to get back to any sort of 50-50 or beyond in terms of rate cut expectations. We do still have CPI data coming out on Friday that could put us right back where we were yesterday, but definitely in terms of what these releases can do, can either, as you know, even if it defies expectations, it could not move these odds at all. It could move them by 5%, but that not really clear any hurdles. But this one, a little bit more gravity to it, with pricing out those rate cuts coming in the summer months, June, or more definitely July at the moment. And this led to some dollar strength and some weakening bonds, rising yields. That started to come in a little bit. A pretty volatile reaction, wasn't one-sided at all. We had the initial almost algorithmic response of dollar strength that paired back a little bit. So some good back and forth movement pre-market today. But on the next slide, let's look at where we'd actually expect these expectations to play out. Looking at 3-month correlations between, the yield curve basically and some major US dollar pairs. And you see that these correlations aren't high at all. Of course, we see a negative correlation or a positive correlation between US dollar and yields, the inverse for these bonds shown here. But I would have expected a lot higher numbers. And of course, this is led by that dollar yen. And I threw in some yen crosses as well because I thought this was really interesting, that euro yen really just as strongly correlated to the U.S. 10-year note as its U.S. dollar pair counterpart. So this shows that, Japanese yen will always be at times very convoluted market to unpack with its drivers ever changing. But there is some gravity to the narrative that Japan, as very large holders of U.S. debt, will be pretty correlated to this. But looking at this and seeing, 0.2627%, I thought, I'm not crazy. This has been higher before. So on the next slide, I looked at the rolling correlation. And it turns out I'm not crazy. Here's the 3-month correlation between the dollar yen or between yen against the dollar and the 10-year note over time. And we can see that this has been coming down significantly from, mid to late 2025 and into 2026. And to me, this is a super insightful point here, because my gut reaction when you get some shift in, rate cut odds is to look to the dollar yen market first, because this historic correlation is in the back of my mind. Today, you would have looked at it and saw that although there was that initial reaction dollar higher, now we're sitting 3 hours removed, and the yen continues to strengthen against the dollar and other crosses. And so a big disconnect from where my mind would go historically and first off. And so just shows you that although this correlation might hold over time and may revert back to its normal range, right now the drivers for this yen are not necessarily U.S. led, much more coming out of this past weekend and the political events that unfolded, a stronger majority for the controlling party, and markets giving the yen and other Japanese assets the benefit of the doubt here, and saying that, the takeaway from that is not that we can assume fiscal policy and stimulus will cause this yen to weaken drastically, but perhaps without this political uncertainty that we've had for a pretty long time in Japan, maybe there is work to be done, and the fundamental picture for the Japanese economy can start to get going and grow at a stronger pace. So that's the narrative taking over for the yen right now. And so the bigger movers from something like this non-farm payroll report have been, the U.S. dollar against the Swiss franc, another similar relationship to the dollar and the yen from an interest rate perspective, but not as much of that kind of debt interaction and differing fundamental picture. So that's where I'm looking at today for the lift in the U.S. dollar. But again, I think this reaction is slightly muted just because we have another event risk, coming in less than 48 hours from this inflation report that'll give us the most up-to-date snapshot on the Fed's dual mandate, and another jolt to the Fed rate cut odds before we'll get we have a lot of time until the next meeting, still over a month until that March 18th meeting. So some more data points to come in.